Hi there, everybody. I just wanted to jump online and run you through a couple of important market releases that we've seen this week that will help us understand some of the volatility you're seeing across financial markets and might help us understand how the year ahead is shaping up. So there's been two key things that have come out over the last 24 hours. The first one was the first Federal Reserve meeting of the year. So the Federal Reserve, the world's biggest central bank in America. This was a really hotly anticipated meeting because expectations about what the Federal Reserve will do this year in terms of interest rates and their QE policy, the money printing, they've changed dramatically over the last 3 or 4 months. And Jerome Powell, Fed chair, came out and confirmed pretty much what people expected, which is that we will see the first US interest rate hike since 2018 in March. And then you'll get a string of interest rate hikes over the course of the year, as well as that quantitative easing that will move into reverse at some point, and you'll get what they call quantitative tightening. So this is all happening in response to inflation, and the US headline inflation rate's tracking about 7% at the moment, which is the highest we've seen since 1982, so it's the highest in almost 40 years. So they're trying to get that inflation under control without sort of letting it get away from them. And that's one of the reasons we're seeing financial markets very volatile as investors get their head around the end of that cheap money from the last couple of years and much tighter conditions, which are creating headwinds for share markets and the economy and just causing lots of movements. So that was the first release that we saw. And we also, after that, on the same day, this was on Thursday, we had the December quarter inflation report from New Zealand. And this was also very high. Not quite as high as the US has been tracking at, but 5.9% for the annual inflation rate. Now, that's the highest we've seen since 1990. So for us, it's a 30-year high, much higher than we would have expected a few years back and higher than the Reserve Bank was expecting. They thought it'd be 5.7. Interestingly, you did have a few of the trading banks who thought it would be higher still. They thought it might have been north of 6, and it might be in the following quarter. But I think what really got people's attention in that inflation release was just how broad-based those price pressures were. We're all very aware of the global situation: rising oil prices, higher commodity costs, supply chain issues that are just causing shortages, and supply demand issues that are pushing prices up sort of in a short-term manner. But what really was clear from that CPI release was the domestic pricing pressures that were also higher than expected, and that's where you sort of start to get that entrenched wage price sort of spiral, and it tends to be a bit more persistent. So I think that's something that the Reserve Bank will have looked at very closely. We'll hear from the Reserve Bank at the end of February. That'll be their first meeting of the year. And remember, they increased the OCR twice late last year, so it went from 0.25 up to 0.75. We'll get another hike in February. Some people think you might actually get a bigger hike than the 0.25%, and that's probably not likely, but you never know. Then we'll get a string of interest rate hikes throughout the course of this year, and the OCR will probably finish at about 2.5%, which is a lot higher, obviously, than we've seen for the last 2 years through this period of the pandemic. So that will have an impact. That will have an impact on borrowing costs. If you've got a mortgage, you're going to face higher interest rates. It's going to cost you more. Take money out of your pocket in addition to the money that's already been taken out of your pocket because of the cost of living with the inflation rate. So we will see the economy slow down a little bit. You will see house prices slow down. Whether we see outright declines is difficult to say. Some people certainly think so, but what is clear is that you will see a sharp slowdown as those interest rates rise, and share markets will face the same headwinds. So this is how the year is shaping up. It's very much going to be defined by what we see in terms of inflation and the response that we get from central banks as they raise interest rates to try and put some downward pressure on that inflation. Now, we don't know how this will all play out. Higher interest rates aren't necessarily the end of the world. Share markets can still perform well when interest rates are rising, as long as you've got economic growth that is also holding up okay, and as long as those rising rates are due to a strong economy, and we just don't know how that will play out. We don't know quite how much of an impact those higher rates will have. We don't know how much of the heat will come out of sort of the inflation backdrop. I think you will see inflation subside over the back end of this year, but does it go back down to very benign levels, or does it sort of stay up, annoyingly high, and the central banks of the world still want to suppress it? So that's sort of the outlook at the moment. I think what's really important for investors is to just acknowledge that it's going to be a more difficult year. Some of the tailwinds, I should say, that we've enjoyed over the last couple of years are becoming headwinds. So we should expect higher volatility, more ups and downs. We should expect more modest returns. It is not the time for taking unnecessary risks. You want to be a bit conservative, a bit defensive. You want to hedge your bets. You want to play this year with a straight bat rather than sort of being, too out on a limb. So I think it's a really good time to talk to your advisor. If you're a Craig's client, you'll have a very capable advisor that will have all the wisdom and knowledge and experience and tools to make sure that your portfolio is set up to weather any storm that may or may not emerge, and to make sure that you've got a portfolio that is well constructed given these sort of conditions that we're expecting. If you haven't got a Craig's advisor, we're always happy to talk, happy to give you some food for thought. But for now, we'll leave it there. Thanks very much for listening. Plenty to talk about this year. There's lots coming in the weeks, months, and the year ahead. So you're going to hear a lot more from us about how all of these things are playing out, what we're seeing, and what we think it means for you as an investor.